Hey, what's up, guys? It's Rohan here. So, the 70s are coming back in a big way. That was the decade that brought stagflation, a nasty mix of high inflation, increasing unemployment, and stagnant job growth. So, let's first look at some of the basic definition of inflation versus stagflation. So, inflation is a broad term that refers to an increase in the prices consumers pay for goods and services as defined by Consumer Price Index or CPI. However, the word inflation only describes rising prices. It does not have anything to do with things such as unemployment or gross domestic product growth, GDP growth that is. But stagflation, on the other hand, is a type of inflation that is accompanied by slow or stagnant GDP growth as well as elevated unemployment. In other words, stagflation refers to a combination of economic condition, not just one. Now, let's look at Moody's definition for stagflation. So they define it like this. We broadly define stagflation as a consumer price index inflation at least 1 percentage point above the central bank equilibrium target and unemployment rate that is at least 1 percentage point above the natural rate and a persistence of these conditions over 6 to 12 months. That's the Moody's definition. The US went through stagflation in the 1970s and it's the only time in their history. Now, the US is not in a recession yet right now, but it certainly feels like they are not far off. If high inflation is matched with high unemployment and a slowdown in economic growth, then they could experience stagflation for the second time in history. Now, let's dive a little deep into the way stagflation works. So, economists originally didn't feel that a situation known as stagflation was technically possible since unemployment and inflation rates tend to move in opposite direction instead of increasing simultaneously. And that's because usually inflation is associated with high economic growth when aggregate demand for goods, services, and labor is strong, coupled with positive animal spirit, optimism about the future, and possibly loose monetary and fiscal policies. You get stronger than potential economic growth and higher than target inflation. Firms are able to set higher prices because demand outstrips supply and workers receive higher wages given a low unemployment rate. In recession, on the other hand, you have low aggregate demand below the potential supply of goods, which leads to a slack in labor and goods market. With ensuing low inflation or even deflation, prices go down as consumer spending declines and unemployment rate also rises. And that's how unemployment and inflation rates tend to move in opposite direction. But stagflation is a term that refers to high inflation that happens at the same time as a stagnation of growth or outright recession, which is very, very rare combination. But then it actually happened in the 1970s in USA when the country experienced 9% unemployment, a slowdown in economic growth, and a double-digit inflation rates. And now it's known that even though stagflation is rare, it can have a devastating impact on the overall economy as we experience a recession where there's still high inflation. Now, let's see what could trigger stagflation. Well, on this question, it's hard to find a general consensus from economists. Stagflation can be attributed to extreme shock in the supply of food or energy, a quick expansion of the money supply in the country, and poor economic policies induced by the government. Now, let's come to the question of why are there concerns about stagflation right now? Well, there's quite a few reasons for that. First, in September this year, US Federal Open Market Committee, that is FOMC meeting, revised down their projections of real GDP growth for this year from their projections in June and anticipated that the US economy would grow at below trend pace in this and the coming few years. Then economic performance remains uneven among the world's major economies, including the US, China, Japan, India, and the negative supply shock from the outbreak of Russia-Ukraine war remains a dominant risk to global growth this year. The IMF has lowered its global growth forecast for 2022 and 2023 to 3.2% and 2.9% respectively, and has said a global recession may be imminent. The World Economic Forum's chief economist outlook for September 2002 surveyed economic leaders from around the world to collect insights on their reading of the global economic situation. The outlook is grim, with 73% of respondents believing that a global recession is either somewhat likely or extremely likely. And along with all these above recessionary pressure, the US inflation hovering near a 4-decade high at 8.2%, and there is no sign it's going to go down soon, and this compares to Fed's target inflation rate of 2%. But if Fed continues to the series of big rate hikes, which it has already done in this year, that will slow down the already slowing economy. Bloomberg just published yesterday that their model is forecasting that a US recession within a year hits 100% probability. Now, the question is, how did we arrive here this time? That is a stagflationary situation. Well, the obvious contributing factor is a COVID-created situation never seen before, when economies around the world all shut down suddenly and almost completely. The complete shutdown didn't last long and the bounce back was rapid, but that created its own problem. An economy going from 100 to 0 in a week or so is disruptive, but so is trying to go from 0 back to 100 in a short time. And for economists, traders, investors, the uniqueness of the situation meant there were no reference points to help understand what that meant, and more importantly, how policy should be shaped to deal with this kind of exceptional situation. Then central bank officials acknowledged that it was too slow to start raising interest rates as the economy bounced back from its pandemic-induced slump and has had to play catch-up in recent months as a result. Yet prices are still rising with no turning point in sight. The Fed's plan for future interest rates might now need to ratchet higher, further narrowing the path between persistent inflation if it does too little and outright recession if it goes too far. And the same is true of today's geopolitical turmoil. Russia's war in Ukraine and the West's response to it has disrupted the trade of energy, food, fertilizers, industrial metals, and other commodities. The Western decoupling from China is accelerating across all dimensions of trade: goods, services, capital, labor, technology, data and information, and other strategies rivals to the West may soon add to the havoc. Then, on the demand side, loose and unconventional monetary, fiscal, and credit policies have very much contributed to the stagflationary situation. The stocks of private and public debt as a share of GDP has skyrocketed, and so is the huge unfunded liabilities of pay-as-you-go social security and health system. Central banks are thus locked in a debt trap. Any attempt to normalize monetary policy will cause debt servicing burdens to spike, leading to massive insolvencies and cascading financial crises. In the United Kingdom, UK, the Bank of England estimates that at the current growth rate, the UK will be in recession by the end of 2022. It follows 7 base rate rises in a row in an effort to cool soaring inflation, which stands at a whopping 10.1% currently. A majority of the Bank of England's Monetary Policy Committee, that is MPC, voted to increase base rate of borrowing by 0.5 percentage points to 2.25% in September, taking them to their highest level since 2008. The Bank of England is really trying to get a handle on the cost of living crisis, while the UK still has one of the highest rates of inflation of any G7 country, including Germany, which stands at 7.9%, and France, which stands at 5.8%. Now, inflation is still way above the target of central banks, and unlike a normal situation of simply raising interest rates will bring greater risk this time. Let's first look at why rising interest rates reduces inflation. The theory goes like this, that if it is more expensive to borrow money, people will spend less of it. If interest rates rises, people might stash more of it in savings account. Less demand of goods and services would hopefully bring prices down and stop inflation from rising so quickly. The US Federal Reserve has so far raised interest rates 5 times this year, and it is expected on November 1 and 2 meeting to deliver another 75 basis point increase in 2022. The benchmark rate stood at 3 to 3.25%. this year, which started from zero. Central banks in much of the world are raising interest rates faster than would have seemed likely only a few months ago. This multinational effort to curb inflation might tighten monetary policy too much. Increase in rates involve a kind of spillover effect. It lowers demand not only for domestic output but also for imports. Failing to take account of this could cause an unintentionally sharp global downturn. So, is there any option to curb global inflation without a global recession? Well, the Federal Reserve and other central banks could, in theory, take account of the spillovers from monetary policy by aiming to manage global demand collectively. Now and then, they have tried during the recessions of 2008, for instance, and most famously in 1985 Plaza Accord on exchange rates. Yet, domestic concerns always dominated their calculations. That's inevitable. Conditions vary widely from country to country and can shift abruptly, making genuine internationally collective action next to impossible. Also, of course, politics is involved, not least thanks to the effect of fiscal policy on demand. For example, for any sort of coordinated central bank efforts among many countries, some complication that immediately comes to mind, for example, how would international central bank coordination deal with the intense downward pressure on sterling brought about by the UK government's new confidence-sapping budget? Then how would it contend with the likely appointment of a far-right prime minister in Italy, which has caused Italian bond prices to slump? Then how would it adapt to President Joe Biden's famous plan for forgiving student debt at a cost of some $500 billion? The most central banks can hope to do at the current situation while wrestling with such complication is to guide demand in their own economies. Now, coming back to the question of how did the last stagflation in the 1970 ended? So the main cause of the 1970 stagflation was an oil embargo, which not only sparked high energy prices but reduced economic activity by hurting productivity. There were other factors as well, such as massive increase in the money supply during those years. The stagflation ended for two main reasons. Oil prices eventually came back down to earth, and since energy costs are a big part of inflation, this naturally lowered consumer prices. The Federal Reserve ended up having to raise interest rates to more than 19% at one point to slow the economy down and control inflation. Now, I'm pretty much ending the video. So the bottom line is we know that inflation is a huge pain, and so is high unemployment or stagnant economic growth. But when all of these things happen at the same time, it creates a particularly scary economic situation that leaves policymakers with some difficult choices. In stagflation environments, the Federal Reserve might be forced to raise interest rates to the point where it severely harms economic activity just to avoid hyperinflation. But the only positive factor in this grim situation is that the labor market is still going strong. We now have two of the three ingredients of stagflation: high inflation, and low or no economic growth. But we are missing the third, high unemployment. That's not there yet. The US labor market is on a tear and shows little sign of contracting, which makes a 1970-style stagflation scenario far less probable. Consider the following. The US economy added another 315,000 jobs in August after tacking on more than 500,000 jobs in July. The unemployment rate is at 3.5%, not far from a 50-year low. Job openings are still plentiful despite the growth slowdown. Much of the labor demand reflects a deep need for certain skills across a range of industries, and the labor supply remains insufficient for the jobs at hand, even with lower growth. Overall, the US labor market is expected to remain relatively tight over the short term, and that's the only bright point in this very grim situation. Alright, that pretty much wraps about this video. If you liked it, do smash the like button, and also don't forget to subscribe. See you in the next one, and thank you very much for watching.